The public portfolio is up around $55,000 to date. So I want to go do a public portfolio update in this video, and then I want to go into a single stock analysis on Hardcore Enterprises, which was an asked question in my comment section. So I'm going to go through that stock and then do a stock analysis of that. So if you like this content, please like and subscribe, and let's get straight into it. So I've pulled up a composition of my stocks in the public portfolio, and as you can see, Meta is by far the largest holding at 42.8%. And then after that, it's followed by Google, which is at 23.3%, then Amazon at 17.9%, HTC, which is Warrior Met Coal, at 14.2%, and then finally ASML, which is a relatively new holding in the public portfolio, 1.9%. So for Meta, they are really focusing on the AI narrative and pushing to make a super intelligence lab. You may have seen in recent news that they hired the Scale AI founder Alexander Wang to head that super intelligence division. And this really underscores how much money they're going to make from utilizing AI. They're already utilizing AI to increase their revenues in advertising. And advertising is their primary revenue segment, revenue generating segment. And the hardware portion of Meta's total revenues is a small percentage, but they're still progressing in the hardware space as well. So recently they announced that they're releasing Hypernova smart glasses, and this is the latest in their line of smart glass offerings. You can see that they're still going to play around with the numbers and seeing what they're going to market this at, but we have to see once these are released what the competition and the demand for these glasses will be. So in addition, they're trying to release their latest Llama models as soon as possible. So in this article, we can see that they're trying to move it by the end of this year. They want to have this out, the 4.x or Llama 4.5, whatever they're calling it internally. They want it out before the end of this year so they can compete against OpenAI and Google Gemini and all these other language learning models. And lastly, I want to mention that even though that they've struck a deal with Google for AI cloud infrastructure space for $10 billion, I think in the future they will start bringing more of that stuff in-house. So this is a good segue into Google, which is one of my top holdings as well. Google has gone up over $70 since the lows in April 2025. And the reason for this, I feel like, is multifold. They were severely discounted because of the regulatory and legal proceedings that were occurring around the stock, and still are. But I think investors have shrugged off those proceedings, and even if they have to break up, I think it will unlock even more value in Google and Alphabet's holdings. But even more than that, they have so many pieces that they can monetize and generate revenue from. So they have YouTube, they have GCP, which is Google Cloud Platform. They got Waymo, they got their new quantum chip division. They have so many pieces to this puzzle. So it's very hard to compete against Google. And I think in the future, their revenues are just going to keep going up in a steady line. And we'll see, as investors and shareholders, we're going to see a nice return from holding this position. So I'm sitting on about $15,000 of profit on Google, and I have no plans on selling this name. And I would say Amazon is in a similar boat as Google. That's my next highest position at 17.9%. And for Amazon, I'm sitting on about $21,000 to $22,000 of pure profit. It's even larger than my Google profit, even though I have less shares than my Google shares. And Amazon is just such a multifaceted business. It has a huge e-commerce and logistics business. It has a self-driving unit called Zoox that they acquired. And it has AWS competing against GCP. And AWS is a first mover in that space. They were the first ones even before Azure and GCP. They have several other things like Whole Foods and other subsidiaries and acquisitions that they've made over the years. So they are a huge player in all of these different sectors and industries. So you can't really bet against Amazon. Next is HTC, and I've talked about this a lot, so I'm not going to get into the nitty-gritty of all the details about it. But I'll sum it up right here and say that Blue Creek, their new mine, is almost finished. They've almost finished their CapEx for Blue Creek. Everything is going according to schedule and on date and on time. And some of the things are even ahead of schedule for Blue Creek. So this time next year, I think Blue Creek will be fully operational and fully in production of met coal. And even though the met coal industry is still in a downturn, when that cyclical industry picks up again and Blue Creek is humming on all cylinders and producing, they've scaled up the production of met coal for Warrior Met Coal, they are going to make money hand over fist. Their free cash flow is going to explode, and their bottom line, their top line and bottom line are going to go up in a dramatic fashion. So suffice it to say that Warrior Met Coal is a play on the future, a long-term play, years into the future, but I think it's well worth the investment that I've put. And I have about 14% of my whole allocation, my whole portfolio in Warrior Met Coal. Will I add to that? That depends on short-term price action a little bit, because I believe in the long-term thesis and the fundamentals, but I would love to see the price, if the price dipped below 50, I would definitely pick up some more shares there. Not financial advice, but that's what I personally would do. And I already have a sizable portion, as you can see, in Warrior Met Coal. So I might look for some other high growth opportunities going forward. But that is a great play for me, and I believe in the long-term trajectory of the coal industry and how it's going to pick up eventually for steelmaking, for the steelmaking industry. And finally, I want to round this portfolio update out with ASML. ASML is the newest acquisition that I've made in my portfolio, my public portfolio, at 1.9%, very small, relatively small position compared to the others, but I'm trying to grow that rapidly. And the reason for that is that ASML has a near monopoly on this industry, the chip fabrication industry. So their machines allowed all the downstream companies to create their chips needed for AI and powering AI workloads. And they have such a moat in this business that their machines cost $400 to $500 million. And the knowledge is not easily replaced, transferred, or any of these things to other competitors, potential competitors in the space. And that's it for the public portfolio. I only have 5 positions here, but all of these positions are strong bets for long-term investing. They will compound their money, compound their reinvested capital at high rates for long periods of time. And that's why I've chosen these companies for these positions. Now, I would be really interested in hearing from the audience or whoever's watching my video, what new positions I should take in the public portfolio. You can put the comments down in the comment section below, and please let me know what you guys think that I should buy next after ASML. Last, I want to go through a stock analysis and fundamental look at Hardcore Enterprises. This company was brought to my attention by one of my subscribers in the comment section. So I'm looking at Hardcore Enterprises on TradingView, and you can see that there's been a recent run-up in the stock price, and this after the earnings, and this is predominantly due to them regaining compliance with the NASDAQ minimum stockholder equity requirement. And so that NASDAQ requires $2.5 million in stockholder equity for all companies. And if they're not compliant with that, they get delisted. So Hardcore Enterprises basically just regained that minimum compliance level. And so you can see that led to a shoot up in the price all the way up to about 168. And now since then, it has fallen down to about $1 in price. So what is Hardcore? So let's go to their website and look at some of the fundamentals here. So they are a leading software development company headquartered in Tokyo, Japan. So they provide software as a service to Japanese companies and companies outside of Japan. Now, as a software as a service company and as in the software as a service industry, these companies have high gross margins usually because software as a service is a low overhead type of business. And so you would expect to see the margins being really high at a company like this. So going back to their website, let's look at their business description. So they do development, sales, and maintenance of various solutions that support digital transformations. So development, sales, and maintenance of CMS, content management systems, customer experience management, and digital marketing technology. All of these things are high margin industries. Development, sales, and maintenance of RPA, robotics process automation, sales and maintenance of process mining solutions, sales and maintenance of Controlio, a task mining solution, sales and maintenance of 3D VR shooting, original service, and management consulting. So they're basically in the software as a service, software applications, and consulting industries. Looking at Hardcore Enterprises on the stock valuation software, I do notice that their trailing 12-month gross margins are 61.8%, which is pretty good. For mature SaaS companies, I would expect closer to 70, 80+% gross margins because it's a low overhead type of industry. Also, looking at the charts for this, you can see their revenues are increasing here, but their net incomes are still negative, their EBITDA is still negative, free cash flow still very negative, and their cash and debts are equivalent. So it's not presenting a good long-term investment for me at the current moment, but it could change based on what they do with their numbers quarter in, quarter out, year over year. And if they are able to show a trend with the revenues going up and the net income going up, if they streamline their operations, show net income, EBITDA, free cash flow increasing and going positive or close to positive in a trend, then it may present a better, more compelling investment for long-term investing. This may be better for like a trade in and trade out, and not really what I'm trying to do with my public account investments. And that's it, guys. So with that, I've done my public portfolio update for this month, and we'll go over some more stock analysis videos in the future. But if you like this content, please like and subscribe, and I'll see you guys in the next one.